Hi, everybody. We have learned the concepts under the business combinations and consolidated financial statements around what is meant by a group, and then we referred to, of course, the business combinations, and we also learned about the terms like control and the goodwill and the non-controlling interest and the parent subsidiary relationship, right? So what I would like to do is now spend some time together where we actually refer to an investment by an entity. Let's say there's an investor, but his investment is not in the form of a control. Okay, neither the investment is in the form of let's say making an investment, let's say in a company, in the shares of the other company, as a usual investment, as a small investment. Okay, so we are trying to say that somewhere between control and a small investment, there exists a space, okay, wherein, of course, the entity or the investor does not have the control over the other business, but it's not too small an investment at the same time. Okay, somewhere there is a possibility of a significant influence. Okay, in a way, the investor has the capability, right? Investor has that voting power that he's able to influence the decision-making power of the entity if not able to control that. Okay, so an easy way to understand is it could be a key investor. Okay, it could be, for example, let's say a large customer or maybe a supplier, right, who directly or indirectly is able to have his say in the decision making. Okay, he's able to have his say in the decision making, and that is where, despite the fact that he does not control the business, the control always lies with the parent, right? So despite the fact that he does not control the business, somewhere the decision making of the parent entity gets influenced by the presence of this investor. Okay, and that is where the term investment in associate starts reflecting. Okay, of course, the standard refers to another term called as joint ventures. So the Ind AS 28 addresses the accounting requirements, okay, for both investment in associates and also joint ventures. And the joint ventures, the meaning of that, the recognition of that is all dealt with under Ind AS 111 that you will understand in a separate discussion. So there's a different standard, Ind AS 111, which is called as joint arrangement, and one of the categories of joint arrangement is basically joint ventures. Don't worry too much about this. There's a complete discussion on that section of joint ventures, right, within Ind AS 111. But the accounting aspect of the joint venture as well is driven by or covered under Ind AS 28. Okay, the job is a little easier because when we say an investment in associate or a joint venture, the accounting is exactly the same. There's no difference in that part. So in a way, when we learn investment in associates, automatically we are also understanding the investment in joint ventures from an accounting perspective. Okay. Now, before we really idea of a significant influence, right? How does it really work in practice? And then briefly talking about also the accounting aspects and how do you usually deal with these things. Okay, your examination would probably test you on explaining, right, that there's a relationship between, let's say, two entities and they expect you to explain whether exists or whether there exists some significant influence or not. Okay, so let's begin. What I would like to do is give you the context of what we had discussed under the consolidated financial statements, right, and the business combination. So we normally talk about those two standards together. Okay, and you would recollect what we had discussed, that there was a term called as control. Okay, and within that concept of control, we said that if an entity has, let's do one thing, let's create a complete line on this. Okay, so let's say it is 0%, let's call it 20% and 50%, and then eventually 100%. So what we say, right, or what the standard says, that if an entity has more than 50% voting power in another entity. Okay, if an entity has more than 50% voting power in another entity, control is presumed. Okay, more than 50% voting power in another entity, control is presumed. And the moment we hear the term control, we say consolidate the business. Okay, consolidate the business of that entity, the entire business of that entity. Okay, all the assets 100%, all the liabilities 100%, and that is how the entire consolidation exercise works. All right, this is something that we have of course discussed within the framework of, let's say, Ind AS 110, which is consolidated financial statements. Okay, but then we also have studied Ind AS 109, financial instruments. Okay, where we discuss that an investment in equity, okay, an investment in shares may either be taken through or accounted for under fair value through profit or loss, FVTPL, or fair value through other comprehensive income, that is FVOCI or FVTOCI, if you want to use that term, right? So in this scenario, we said that the use of the fair value is done. Now, when do you do that? When that investment, okay, when that investment does not result in control or significant influence. When your intent as an investor to buy the shares in the other entity is not to really run the operations or influence the decision making of doing those operations. You are another investor. You're just buying the shares in the company, maybe for a value increase over a long term, or maybe for trading purposes in a short term. Okay, so what Ind AS 109 talks about is that it does not result in control or significant influence, and it is again presumed, right? So the word presumption is important. It is presumed, again, the way we presume that if more than 50% of voting power is there with you, then the control is there with you, right? And then there's another benchmark where we said that if it is between or up to 20%, it's between 0 and 20%. I mean, it cannot be 0 effectively. It is up to 20%, of course. Then we assume that the accounting would be dealt for under Ind AS 109, under the financial instruments accounting. Okay, and of course that is where the final categorization comes, that you neither have a control because you don't have the majority stake, for example, nor it's a small investment, right? You're not a very small investor that you attend an annual general meeting. You don't have, let's say, a board representation. Just to highlight how do you probably have a possibility of creating significant influence, right? But you have something, so anything which is more than 20% and up to 50%. Okay, you are a key shareholder. You are a large shareholder. You will be heard. Okay, so these are all the things which start coming in. That presence or the voting power itself gives you the authority to influence the decision making of that investee company. Okay, you are a significantly large shareholder, or you have a significantly large voting power. So you don't have to be a shareholder necessarily, because the voting power may be also obtained indirectly. Okay, but then again, from a benchmarking perspective, we are saying that if you are a shareholder with more than 20% shares and let's say up to 50% shares in another entity, you have, or you are in a position to significantly influence the decision making of that company. And that is where this becomes an example of an associate. Okay, so that investment made by you in the other entity would be called as an investment in associate. That's a technical term that we use to reflect that this guy has significant influence over the policy making or decision making, and we refer that very specifically, the strategic decision making. Okay, not just usual basic administrative tasks. So the strategic decision making, you are one key shareholder who cannot be ignored. All right, you don't have the control, but you're a large shareholder certainly there. Okay, so that's what you want to remember. From an examination standpoint, if it is more than 50%, control is presumed. If it is less than 20%, Ind AS 109 financial statements or financial instruments gets attracted. But anything between 20% and up to 50%, anything which is more than 20% and up to 50%, significant influence and investment in associate is available. Now, your examination, they might use the word significant influence, or they may altogether ignore that. And they give you, let's say, a percentage. Let's say they say 35% shares, that you as an entity own 35% shares in another entity. Okay, so from that perspective, significant influences expected to be there, is presumed to be there. Okay, now of course the argument that comes, so I've been really focusing or emphasizing on the word it is presumed, right? Now why do we say that it is presumed? Because it is not mandatory. Okay, so even if it is, let's say you have a 40% stake, we assume that, or we presume that the significant influence exists, but it may not be there. The way we talked about the control aspect in case of consolidated financial statements, more than 50% suggests or expects us to believe that the control exists, but may not be there. So it's not a rule again. So from an examinations perspective, look for this term, the word significant influence. All right. And if that is not present, but they only give a shareholding, you can safely assume or presume that significant influence exists. Of course, the examination can also ask you that they may say, you have a, let's say, more than 20%, could be 35% again, and they give you certain conditions, and you are asked to assess whether there exists significant influence or not. So be careful when you read the question. Be very, very careful about what exactly is the question trying to ask you. And of course, you need to remember these parameters as well. Okay. Up to 20%, don't worry, financial instruments, at risk. More than 50%, consolidation is at risk, or consolidation is attracted. Between 20 and 50, right? Between 20% and 50%, significant influence comes into the picture. Okay, right? That's something that you want to remember at this point in time. So the other argument that comes, let's say I have 40%, let's say I have 45%, let's say I have 49% stake in another company. Now, how do I deal with that? Okay, because there's another entity. So let's say for the sake of argument only, let's say there's a company X. Okay, there are two shareholders, company A and company B. And let's say this company has 70% shares and this company has 30% shares in company X. And accordingly, the voting rights are also in the proportion of 70:30. Okay, now what would that signify? That would mean that there is presumed to be a control with company A, which means that company A will consolidate the entire business of company X. So there's 100% consolidation of company X business. All the assets and liabilities will be consolidated in the books of company A from the group's perspective, just to highlight that more precisely. Okay, but how about company B now? We say because it is more than 20% and less than 50%, we assume there is a significant influence, right? So whatever decision making that company X is doing, right? Of course, A has a control over that, but B also has an impact. The availability or presence of B cannot be ignored, right? So the word significant influence suggests that somewhere company B has an influence on the policy decision making, and in return, the profitability of company X. Okay, so when this happens, we are saying that under significant influence, we follow something called as equity method of accounting. We follow an equity method of accounting. Now, what does it mean? It means that you only consolidate or you only pick the share of profits in company X. You only consolidate the portion of equity, right? So when I say the word profits, I would also want to include any reserves or the items appearing in the other comprehensive income. Okay, so A consolidates 100%, but B takes its share of the equity from the company X perspective. And that is the reason why the term or the standard uses the reference of equity method of accounting. And that is where, as we said before, that the accounting is also applicable for joint ventures, which is covered under Ind AS 111. So let's not worry about that part, because when we are discussing the accounting under Ind AS 28, we are automatically covering the accounting for both an investment in associate as well as an investment in joint venture. Okay, so the key questions that we want to address from this particular standards perspective are: what is the meaning of an associate? What is the meaning of significant influence? How do we do the accounting for investment in associates? Something that you expect your examiner to be, assessing you on. And finally, what is equity method and the application in accounting for investment in associates and joint ventures? Broadly, how do you do the equity accounting, or how do you do the accounting under the equity method? That's what you need to understand well. Okay, from an examination standpoint, this was tested in the old syllabus. Nothing has been tested in the new syllabus so far, but what you like to remember here is that it's a part of the group financial statements. There is a possibility that it becomes, or it is tested as a part of consolidated financial statements as well, or there could be an independent theory question, right? There could be an independent theory question that may be tested, with respect to assessing the knowledge or accounting for, let's say, the investment in associates. We have several case studies and scenarios talking about those aspects, okay, where we try to understand that whether in a particular scenario does the accounting apply, or do you believe that an investment in a company would meet the criteria of accounting for, let's say, an investment in associate. Okay, so that's how we want to kind of go forth and apply the understanding, and a lot of the references we keep on hearing, or we keep on getting, is coming through again, the consolidated financial statement. So this is a fairly straightforward section. We will be discussing, as we have talked about under the consolidation, something on the URPs, unrealized profits, okay, something on intragroup transactions and balances as well, okay. And believe me, this is a fairly straightforward section, right? It can be a little complicated, it can be a little overwhelming when you look at consolidated financial statements, but once you are, and as we have done those discussions already for the parent subsidiary relationship, this one is a piece of cake in comparison to what we have done there already. Okay, so be very, very comfortable, be better relaxed around how do you look at the accounting under investment in associates. What do you want to remember? Equity method of accounting. You only consolidate equity. That's the way you want to understand this particular section. All right. So how do you see this? We say that the standard shall be applied by all entities who are investors with joint control of or significant influence over an investee, right? What is a joint control? There is a reference of something called as collective control, right? That is specifically discussed in detail under Ind AS 111, joint arrangements, okay? It's just the scoping part of it. Don't worry too much about that part. There's a very comprehensive discussion of the meaning of joint control separately. What we want to focus on is significant influence. We have heard it already so far, in this discussion, that there is significant influence between 20 and 50%. So what is that all about? That's what we want to discuss. Okay, less than control, but not a small investment. Less than control, not a small investment. That is where the word significant influence comes. And that is where we start understanding it better. Okay, we are saying that an entity over which an investor has a significant influence. Okay, that's where we refer to the term that it's an investment in an associate. Okay, now how do you exercise? How do you conclude that whether you have, or whether there is present significant influence or not? Okay, very common aspects when there are, let's say, material transactions between the entity and its investee. You've made some investment in an entity and you're doing significant business with that entity, right? In a way, you are able to influence the decision making of that entity. Okay, There could be, for example, representation on the board of directors or equivalent governing body of the investee. Of course, all those strategic decisions, operational decisions, business decisions are made through the board. And if you as an investor have a representation on the board, please always bear in mind we are not using the word control here, right? Even under the control, these things exist, the board representation and shareholding. Okay. But then we are saying that you as an investor are present in the board. You are contributing to the discussions. You are able to share your views, and the presence can be impactful. That's where you look at the representation on the board of directors or maybe an equivalent governing body. Okay. Likewise, are you really involved in the policy making decisions, right? Is there an active participation from you, right? So and that, by the way, that certainly differentiates between you and another investor who's merely looking at, I'm present, I'm just present because I need to be present. Okay. I'm not actively participating, I'm not actively contributing, or I'm not really influencing the decision making. I'm here because I'm here to safeguard my investments, and I leave it to the other board members, I leave it to the other decision makers within the policy to decide, and I'm just present. Okay. Sometimes we may say that independent directors do not really participate. They are merely watching, they are merely understanding. So they're more present from a protective, or to have the protective rights available. They're not exactly participating. Okay. So they may not directly influence or even control, of course, from that perspective, right? Similarly, we may see that if you as an investor are able to, let's say, bring along or bring on key management personnel from your side. So is there a position that you're carrying where you can change the managerial personnel? Not of course all of them, because the control may get attracted, but in general. Similarly, if you are somewhere having the capability to provide essential technical information, you are such a key player that you are the one who's probably running the show. So in that context, you would see the evidences of significant influences. Okay. Now, what is critical to understand? Not all of these aspects need to be present. One or more of these evidences can suggest that somebody has a significant influence. Okay. Now, but that, by the way, reminds me of one more point. We said that, if I look at it, less than 20, don't worry. More than 50, don't worry. So between 20 and 50, we reflect or we refer to something called as a significant influence. Okay. So what does it mean? If I say there is one company, which is company X, okay, and let's say the company has 3 shareholders. Okay, let's call it company A, company B, and company C. Okay, let's say company A has 55% of the voting power in company X. Company B has 22%. I'm just taking a number because we want to kind of connect with something. So 55 plus 22 makes it 77, and let's say this is 23%. Okay. Now, what do we assess here? What do we get here? We're saying that, well, we can safely presume that company A has control. Nothing wrong in that. More than 50% is control. Okay. Then both company B and company C are expected or presumably have a significant influence on the decision making of company X. Is it a right observation? The answer is yes. You can have more than one entity who can exercise significant influence over the investee. But the moment I say it's control, to be a parent, you are the only entity who's presumed to have control. Okay, don't worry about the shareholding part, right? What is essential to take out of this discussion is that if you have control, you are the parent, and two entities cannot have control at the same time. Else, it would be an example of a joint control, which is not a parent subsidiary relationship again. Okay, so there can only be one parent, but there can be more than one entity with significant influence in the investee, okay, or over the investee, I would like to say. All right, just a takeaway out of that. Okay, so what is significant influence? Of course, power to participate and influence in the financial and operating policy decisions, and these are expected to be strategic decisions. Okay, the finalization of the budget, for example. Okay, when you look at, let's say, the new decision making, let's say, from an operations perspective, creation of a new business vertical, right? Selling off, let's say, or disposal of a business. They're all examples of strategic decisions. So somebody who's participating in those policies and is able to have a say on the decision making, not necessarily control, is going to be an example of significant influence. Okay, of course, we mentioned that specifically, that the control or joint control should not be there. Okay, which means, by the way, just to clarify, if there is a company X and there are, let's say A, B, C, and D, with each of the shareholders having 25% stake or the voting powers, we may say, well, are they all having significant influence? Probably. But then if I were to understand it like this, that all these people have to have a unanimous consent to eventually take a decision. Okay, so we don't use the term significant influence. We are using the reference of unanimous consent and call it a joint control, right? Again, I wouldn't want you to worry too much about the term joint control. That is something we want to discuss under Ind AS 111. Okay, so precisely in this context we are referring to, so this could be a better example for us to understand what is significant influence. We said already, this is general presumption. If you have 20% or more of the voting rights, right, whether directly or indirectly, maybe through another subsidiary, you may have more than 20% voting rights that way. So it may result in a significant influence, or it may not result in a significant influence. So you take the presumptions, but you have to validate. The way we did the validation for the word control under the consolidated financial statements is the similar treatment that we do. Okay, so there's no rule which says if it is more than 20% and less than 50% or up to 50%, it has to be significant influence. In your examination, however, you can safely assume that this is correct, unless the examination or examiner wants you to test that understanding. All right. So when I look at the analysis of voting rights, as we said before, if you have 20% or more of the voting rights, it is presumed that you as an investor have significant influence, unless it can be clearly demonstrated that, well, it is wrong, it is not true. Okay. Similarly, if you have less than 20%, then we can assume safely that you do not have significant influence. However, it may be there. So the circumstances, the facts of the case need to be assessed, right? The way we assess for control, it's a similar way we want to assess even for understanding whether there exists a significant influence. So the shareholding is not necessary, but the presumption plays a key role. Okay, so that's something that you want to remember at this stage. Let's have a look at this scenario. It says that Sun Limited has invested 20% in Solar Limited and has a right to appoint one director on the board of Solar Limited. The board in total comprises of 5 members. The balance shareholding of Solar Limited is held by 2 other entities, and they have a right to appoint 2 directors each. Okay. Solar Limited requires a quorum of 4 directors for board meetings. The decisions are to be taken by the majority of those present. The board meetings are frequently called upon by other shareholders at a short notice, and they make decisions without the presence of Sun Limited's representative. Also, it is noticed that suggestions by Sun Limited's representative have been opposed by other directors when included in the agenda. Right? There's a lot of information given. The question is, based on the facts above, whether Solar Limited is an associate of Sun Limited. Now, in this case, what you want to pick up, what you want to understand is that there is an entity called Solar Limited, and there's an investor Sun Limited. I'm just picking that number correctly, or the names correctly, right? So there's a 20% investment made by Sun Limited in Solar Limited, right? So the board of Solar Limited, this has 5 members, right? So let's call there's a company X with 2 members, Y with 2 members, and Sun Limited, of course, with 1 member. Okay. Similarly, there are 40% shares, 40% shares, and 20% shares. That's how you're looking at the entire, holding. Okay. Now, of course, it doesn't really specify whether it is 40% each, but that's not really relevant here. Okay. So when you look at the decision making, of course, the board could be or is a place where you look at the decision making. So you need a quorum of 4 directors, which always means, in the given context, that both X and Y need to be always present to conduct the board meeting. The presence of only Sun Limited, or along with, let's say, one of the the other company's representatives, even if there is a one company's representation, that would not allow even the board meeting to take place. Okay, so essentially, from the quorum's perspective, Sun Limited's representation is not sufficient. Okay, so that's one part that you want to remember. All right, and then you're looking at it that the other shareholders are doing those meetings at a short notice, and they are doing those decisions without the presence of the representation from Sun Limited also. Further, the minutes suggest that even if Sun Limited's representative is recommending something, well, that is simply being ignored, or that's being opposed by the other directors, right? So even though in this scenario, right, we talked about 20% to 50%, that's our relevant area. Okay, so even though Sun Limited has 20% of voting power in Solar Limited, okay, the scenario suggests, or it appears that there is no presence of significant influence, right? By virtue of these, fact of the case, it appears that even though the voting power is there to the extent of, let's say, 20%, okay, to the extent of 20%, the voting power exists from, for Sun Limited, likely because the influence is not present, right? There's no participation, there's no let's say availability in terms of the decision making, right? There's no say, practically there's no say in the board meeting. So we may want to conclude that the shareholding or the voting power does not really create a difference here. And that's what we were saying, that it is only presumed that with 20% or more, you have significant influence, but you look at the further, you look at more facts, or you look at the facts of the case. So in a way, we are saying that in principle, if an entity holds 20% or more or the voting power of the investee, it is presumed that the entity has significant influence, unless it can be demonstrated clearly that this is not the case, right? Of course, even though Sun Limited holds 20% along with the right to appoint the director, it appears that Sun Limited cannot exercise for reasons. For example, other shareholders carry a significant portion of the shares, and they prevent Sun Limited to exert that significant influence because they are conducting meetings at a short notice. Okay. Similarly, suggestions by the representation, of Sun Limited in the board meetings, they're not accepted. Rather, they're being opposed by the other directors. That also indicates that Sun Limited, even with 20% stake, does not have a power to participate in the financial and operating decisions. So from that perspective, we want to conclude that Solar Limited will not be an associate of Sun Limited. Now, what does it mean from an accounting side? We simply say that this might be covered through Ind AS 109 and not Ind AS 28 in our example. Okay. Let's have a look at another example here. It says that AB Limited has made an investment in MN Limited. It currently holds 14% shareholding of MN Limited and also has a right to appoint 2 directors on the board of MN Limited, which comprises of total 8 members having 1 vote each. The question is whether MN Limited is an associate of AB Limited. Okay. Now, importantly, what you want to bring here is, we use the timeline always to understand it better. When you look at this shareholding somewhere here, this is the voting power that AB has got as far as investment in MN Limited is concerned. So on the face of it, purely on the voting power basis, it is unlikely that there is a significant influence. But the moment you bring the decision making, right, you have got 25% of board's representation, right? You got 25% of board's representation because 2 directors out of 8 are your representation. So that 25% is likely to, right? Importantly, that 25% of the board's representation is likely to suggest that there is a significant influence that AB Limited has got in MN Limited, right? So it does not matter. You're not holding 20% stake, but it's not exactly the only, it's the only criteria. You need to assess that significant influence in all the circumstances to assess that part. Okay. And let's have a look at the formal solution. Of course, the principle suggests if the entity holds directly or indirectly, for example, through subsidiaries, less than 20% of the voting rights, it is presumed that the entity does not have significant influence unless such influence can be clearly demonstrated, right? And then we are also saying that since the representation on the board would be a very clear evidence of existence of significant influence, and 2 out of 8 directors could be, let's say, could be a factor wherein it is proved that AB has the power to participate in the operating and financial decisions of MN Limited. So it can be concluded that MN is an associate of AB Limited in this case. Okay, let's have a look at some more aspects here. It says that there's a participation in policymaking processes, including participation and decision about dividends or other distributions, right? One of the cases available, say that says that North Limited forms as SPV, a special purpose vehicle. We use this reference in the consolidation, right? We use it in the context of the group accounting, right? So North Limited forms a SPV for a specific purpose. It has less than 20% voting rights in the SPV. However, it is able to take key decisions about the SPV through other contracts that provide North Limited with the power, including the distribution of profits decisions. So in that context, the significant influence is visible. It can be demonstrated that the investor North Limited has a significant influence over the SPV. Okay. There's another instance which says that Edge Limited holds 10% voting rights in ABC Limited. In addition to the voting rights, Edge Limited has veto rights over critical relevant decisions with respect to recruitment, termination, remuneration, capital investment, budgeting, and other operating decisions. Okay, so when you look at this scenario, there is merely 10% shareholding that you have got. As Edge Limited, you have less than 20% stake. So you cannot presume that significant influence exists, but you do have a say or a final say, in all these areas. So there could be strategic, decisions on the capital investments, on the budgeting part of it, or the termination of people, for example. So in that context, the significant influence is likely to be present, okay, with Edge Limited, and accordingly, the investment in ABC Limited may, for example, in this case, be considered as, let's say, an investment in associate. Okay. There is yet another scenario. It demonstrates how do you look at or how do you assess material transactions. Okay. It says that Texture Limited is in textile business, manufacturing for a large retailer, Mart Limited. Mart Limited has a shareholding in Texture Limited with 12% voting rights, which was acquired several years ago at the start of this relationship. As per the agreed terms between them, Mart Limited provides all the designs for the products and also is involved in drawing up the production schedule, timing, and the quantity to be manufactured by Texture Limited. Also, more than 90% of the total production is purchased by Mart Limited. Whether Mart Limited has a significant influence over Texture Limited is something which is the question asking us. Okay. Now, again, you bring that perspective, anything less than 20%, you cannot presume significant influence. Let's quote it through SI. But very clearly, Mart Limited, even with 12% voting rights, may demonstrate that the designing element, drawing up the production schedule, the timing of those, how much units to be manufactured, 90% of the business of Texture Limited is driven through Mart Limited. So these material transactions very, very clearly are indication, and they demonstrate that Mart Limited has significant influence over Texture Limited. So the decision-making aspects with respect to production scheduling, the timing of that, number of units, maybe you look at the pricing part of it. I mean, imagine you are procuring 90% of production of Texture Limited. What if you tomorrow decide to do something else? Okay, that is a very clear, evidence where the significant influence exists, even though it is less than 20% in the given scenario. Okay, so let's have a look at the formal solution. In the current case, Mart Limited holds a less than 20%, which may indicate that there is no influence. However, considering the involvement of Mart Limited in the production phase, and also the fact that 90% production is lying with, or 90% production is purchased by Mart Limited, very likely the existence of influences there, significant influences there, because of the dependency that Texture Limited has got on Mart Limited, right? Mart Limited can very well, suggest the changes in pricing, and very likely Texture Limited would have to simply accept, what is offered by Mart Limited. So that's how you start looking at, the influence on the pricing decision. So there's a very clear indication of availability or the presence of significant influence in this case as well, right? So many examples we see that even if it is less than 20%, very likely it falls in the context of significant influence. Okay, let's have a look at yet another example. It says that during the year ended 31st of March 2020, P Limited has taken a 15% voting interest in Q Limited. The remaining 85% of shareholding is widely dispersed among public investors, with no investor holding more than 1% stake. You would recollect this is a similar scenario where we were referring to the availability of control, even if you don't have, for example, a majority stake. So it's not very different from those lines. Okay. It says further, in addition to the voting rights, P Limited is also the sole supplier of a major raw material used by Q Limited in its production. P Limited also provides technical know-how in relation to the factory operations of Q Limited. Very clearly, you can demonstrate 15% is not really relevant here, although it may indicate that there is no significant influence. The moment you start taking all these aspects together, all these parameters are critical and they help you assess that with all these factors, you are a major supplier, you are providing technical know-how, you are holding significant number of shares when compared to other shareholders. So very likely the significant influence is available in this case, right? So from that, so you're using the information from the question itself, right? You're using the information from the question itself, and you can clearly demonstrate that, look, I know the answer. It's very, very evident to me. So always read that requirement carefully, and the answer is always available, right? So you just need to kind of read the information carefully and you get that answer there. Okay. Let's have a look at yet another question. A lot of information. It talks about interchange of managerial personnel. Star Limited and Sun Limited are both in the shoe manufacturing business, operating in different regions. Star Limited has made a strategic investment in Sun Limited with a 12% shareholding. As a part of operational assessment of Sun Limited, it is decided that a new production process is fundamental to the change in long-term strategy of its business. And as a part of the agreement, it is agreed that Sun Limited will work to set up the new process under the supervision, okay, of two senior management personnel from Star Limited, okay, one of whom is on the board of Star Limited, right? So what we are seeing is that Sun Limited will work to set up a process, and it would be under the supervision of management personnel from Star Limited. Okay. These management personnel will supervise the critical activities. Okay. For example, purchase of new machinery, recruitment of new staff, training, etc. These management personnel will report to the management of both Star Limited and Sun Limited. The question is whether Star Limited has a significant influence over Sun Limited here, right? So the key points that you want to pick up is it is 12% shareholding. It is unlikely that significant influence exists, right? However, for Sun Limited to operate, okay, it works under the supervision of the senior management personnel from Star Limited, who shall supervise everything, right? So when you look at the operational and the strategic decision making, right, the supervision of those, right, that is being dealt with by the management personnel who are, for example, coming from Star Limited. Okay, so even though there is a 12% shareholding, we may consider, right, that the presence of these managerial personnel, right, the availability of these managerial personnel who are, let's say, working through Star Limited, who have a presence on Star Limited through the, on its board, very likely can reflect availability or presence of a significant influence there. Okay, because the decision making with respect to the production processes, the decision making rights would be likely going going with, let's say, Star Limited, right? Since the production process is important from a long-term strategy, it may be concluded, right, the Star Limited has the power to participate over the key operating and financial decisions, and accordingly, there is a significant influence available. Okay, let's have a look at this scenario further. It says that MN Limited is in the business of manufacturing mobile handsets. It has 17% voting rights in XY Limited. In its production process, MN Limited uses the technology developed and licensed by XY Limited. Okay. XY Limited provides updates pertaining to licensed technology on a regular basis. These mobile handsets developed using XY's technology represents more than 95% of MN's entire sales. Okay, so when you look at the relationship, okay, we are saying that now what you want to understand also, that if you want to confer the significant influence, we want to confirm the significant influence, it's important to understand, it's important to assess that whether those voting rights are currently available or are these potential, right? That's something that we want to kind of talk about here. We would like to highlight that. So this is a little different from what we studied under the control framework, right? So here we are trying to say that an investor may hold any instrument, for example, a share warrant or a call option or a debt or equity instrument issued by the associate. And the terms are suggesting that the holder will get an equity right on the expiry. For example, there could be convertible into ordinary shares, which would give additional voting powers or may reduce somebody else's voting power, okay, over the financial and operating policies of another entity. That's something which is a common attribute, you would see in case of some instrument which have a potential to become shares in the future. Now, what we are saying here is, importantly, you only refer to existing rights, okay, for determining that significant influence. Any potential rights that may arise in future, they are not considered today to determine whether some investment in a company would be an investment in an associate or not. That's something that you wanted to kind of just take into consideration when you look at this particular paragraph. Okay.